Welcome to another special edition of the 3 in 10 podcast. These discussions with investment or industry leaders are set apart from our regular Friday podcasts. They are both longer and more in depth. We hope you will enjoy, learn, and profit from this special edition of the 3 in 10 podcast. Welcome, everybody, to another special edition of the 3 in 10 podcast. Today, I'm really excited and honored to be with my friend of about 30 years, Doug Terreson, who was really one of the best overall well-rounded securities analysts that I ever worked with. And Doug and I worked together at Morgan Stanley for at least 10 years, from the mid to late 90s all the way through the first half of the 2000s. And what I'd say about Doug was that he was a company expert, foremost a money maker. He helped our clients make a tremendous amount of money with his strategic thinking on not just the energy companies, but the strategy, the strategic part of what was going on in the industry at that time, which was truly extraordinary. We called it the era of the super major. I think that was Doug's branding. He had great oil models and refining models. I think your refining model was probably one of the greatest. He was an investment banker, a tireless marketer. He really checked all the boxes of what makes an analyst great. And so with all that's going on geopolitically and in the oil markets, Venezuela, Iran, we're going to get into all of that. But I thought it would be timely to have Doug join me for a fireside chat. And so I'm going to just ask you, Doug, the first question. Just tell us a little bit about yourself and your background and your career in energy and securities.
Okay. Well, first of all, Scott, thank you for the gracious introduction. I've always enjoyed, working with you over the years. You are always a complete A player and somebody whose judgment that I really found valuable. I always valued your judgment and your thoughts on the investment items that we debated over the years. And so, the 20-second sketch of my background is as follows: petroleum engineer, Mississippi State University. I then joined a Schlumberger and I became a directional driller in the deepwater Gulf of Mexico. I drilled, oil wells 120, 130 miles out in the Gulf of Mexico and some onshore as well. And I really learned the industry from the ground up, meaning I learned, the culture of the companies, all the processes and what have you. And that was super valuable to me when I became a financial type. And so love the oil industry. I worked for Schlumberger for several years, and I decided that I wanted to become involved in finance. I was just fascinated by Wall Street. Never thought I would end up being a person that was capable of working there. Get an MBA from a place called Rollins College in Winter Park, Florida. And then I go to the buy side for about 6 years, most recently at Putnam in Boston, where I managed, the 56th largest energy fund in the world. So got a good background with Schlumberger, good financial, learnings from my MBA. And then I also did the CFA. And then I started to manage money, and I never really planned on leaving the buy side. I mean, I thought my natural talent was in investing, and I really enjoyed it. Putnam was a fabulous place, really loved Boston. But then about a couple of years into it, I got a call from Wall Street. And when Morgan Stanley called in the early 1990s, you answered the phone because it was a unique, elite group. It was very difficult.
It was a powerhouse. It was really fun to work there in the 90s, wasn't it?
Well, it was great to work there, Scotty. And it was one of those things where, unless you were, an Ivy League type, unlike you and I, University of Texas for you, Mississippi State for me, because they needed some energy people, it was kind of hard to get a job there. So anyway, I go to Morgan Stanley. I managed their global energy group for about 15 years. As you indicated, I was a research analyst and an investment banker for a period, which was fabulous. Well, we had a lot of the strategic themes that led to some of the most significant changes since the breakup of the Standard Oil Trust back in 1911, 1912. Then I took a year off, 2008, and then I managed Evercore's global energy group until around the middle of 2021. And since then, I've served on boards. I'm on the Phillips 66 board. I'm on a board called of a company called Third Year Energy Fund, and I'm also a longstanding member of the Mississippi State University board. So that's kind of the 1 minute sketch of my background, and it's been a fabulous ride, and so fabulous that I wrote a book about it. It's called Can't Deny It, and Can't Deny It's done very well. And the reason I wrote it is because so many people just said, Doug, you've got to write a book. You've got to write a book. You've had all these experiences. And so I did. And it's done very well on Amazon. I've been, really flattered. I did it just really for fun, but people seem to enjoy it. So lots of lessons in it.
Got a great story to tell. It doesn't surprise me at all that people want to read about it. And the energy markets are so interesting and topical right now because they seem to be infused with geopolitics and in some cases driving geopolitics. But we've had this structural oversupply for the last 2 or 3 years, and prices seem to just be holding on to that $59, $60 a barrel level for dear life. And just help us understand the current fundamentals in the oil market.
Sure. So first of all, your view is correct. Over the past couple of years, the oil market's been very volatile, and it's actually been on a downward path. I mean, if you go back a couple of years, I think oil was maybe 2 years ago, right around 85 to 90. I think that's probably the longer term equilibrium price. I think that is the price that the industry needs to earn its cost of capital, and also the price that OPEC needs to balance budgets. But periodically, as you're aware, we can go way above that and way below that, depending on the specific fundamentals in the market. And that's exactly, as you indicated, why we're at a lower price level today. As you pointed out, demand growth or fundamentals seem to be pretty good, but they seem imbalanced to me this year. I mean, we're kind of passing an inflection point whereby supply and demand and inventories were balanced to one end where they're imbalanced. And what I mean by that is that demand growth continues to chug along. It's pretty healthy around the world. Growth was right around 1 million barrels per day last year. It'll probably be 1 million barrels per day or so this year as well. You could argue, but Doug, what happens if the U.S. economy continues to roar ahead? What happens if interest rates decline? Well, then, demand growth may not be 1 million barrels per day. It could be 1.5 million barrels per day, and that would certainly help. But that's not the problem. The problem is that it is really on the supply side, and specifically, if you go back to last year, OPEC elected to unwind some of the cuts that they made several years ago when they were trying to support prices. As you're aware, OPEC, somewhat out of the blue, to the surprise of a lot of people, elected to increase production in April. Then they did it again in May. Then they did it again in June. And then they did it again in September. And so the whole point here is that demand growth looks pretty good, may surprise to the upside this year. But supply growth, I think, is going to overwhelm that demand growth in a way that we're going to have pretty meaningful builds to inventories in the first half of 2026. And the implication is that prices are likely to decline. But I think traders are probably reluctant to be short oil with what's going on in Venezuela, even though they're not a substantial producer today. What's going on with Iran today as well, which is a substantial producer, and they produce almost 4% of global oil supply. And so I think everybody's on watch for geopolitical disruption and maybe disruption in supply. But all things being equal, if Venezuela and Iran obviously get solved and production is not disrupted in a significant way, I think that we're going to see some pretty meaningful imbalances, big builds in inventories in the first half of this year. And the Brent price, which has been as high as 65 recently, could go to the low to mid 50s in 2026, which would obviously be positive for the U.S. consumer because that means gasoline prices would be kind of 10 to 15% lower than they were last year. So that's kind of the fundamental outlook for crude oil. Prices have gone from kind of 90 to the 60 level, but quite frankly, if we see some of these situations, whether it's, Venezuela, Iran, or Russia become resolved, then the balances could reset. It's just hard to know exactly how they'll be reset.
Well, I'd like to segue now to Venezuela because I know your background. I know you've been there many times. I know you worked with PDVSA in the 90s. I think maybe even helped to bring that company public. you know Venezuela very well, and talk to us a little bit about what's happened, what they used to produce, what they could potentially produce, and are there any quick fixes, or are we looking at many years before production can really get back to potential?
So all very good questions, Scott, and you're right, and can't deny it. We talked about Venezuela and what could have been in that country. And to kind of set the table, as you mentioned at the outset, we had this theme in 1998 called the era of the super major, which suggested that because of a very new and different, more challenging competitive framework, that the big oils need to combine. And if they did, then that would lead to great prosperity in the sector if they followed the value-based model. As they did that, that changed the competitive framework as well. And that made a lot of the national oil companies around the world sit back and say, oh my gosh, we probably need to restructure our oil industry, probably need to have access to capital and technology by privatizing. And so because the era of the super major was our theme, and we advised on every transaction except for one during that phase, that positioned us to be the advisor of choice to all the different national oil companies around the world. And so we began by restructuring the Chinese oil economy and privatizing Sinopec. That worked out fantastically. Sinopec ended up being a 10-bagger. It is now the fourth largest company in the world. So the privatization of Sinopec obviously went very well, not only for us at Morgan Stanley, who were the advisors, and myself as the analyst who took it public, but also for the people of China. We were then involved with Statoil in Norway. Statoil was much simpler than Sinopec was. As you may be aware, because Statoil, which is a national oil company of Norway, was successfully privatized, and because the government wisely used the funds from oil revenues during or since then, Norway now has the largest sovereign wealth fund in the world at about $2 trillion. And oh, by the way, to your question, Venezuela has oil reserves that are 50 times larger than that of Norway. So the question becomes, and the question I raised at the outset is, well, oh my gosh, what could have been for Venezuela? So in the late 1990s, we, Morgan Stanley, spent a lot of time trying to convince the board of PDVSA and the government in Venezuela that if you allowed us to help restructure the Venezuelan oil economy and take the company public, it could change the lives of generations of Venezuelans. And you may be going, well, Doug, that's a pretty big statement. What exactly are you talking about? Well, in the end, we suggested that we, Morgan Stanley, could privatize 1/3 of PDVSA and pay off all the debt of the government of Venezuela, which at the time was a full $27 billion. Complete no-brainer if you think about it. And so that was 1997. As you may remember, in early 1998, the Saudis and the Venezuelans got into a disagreement in OPEC about who was the low-cost producer. The Venezuelans were taking the Saudis' market share in the United States. That was a market share that was closely guarded by the Saudis during the previous couple of decades. The Saudis warned the Venezuelans did not take heed. One thing led to another, and everybody increased production significantly at the failed Jakarta OPEC meeting. And what we found in 1998 was that the price of oil collapsed. It went from $20 to around $10 per barrel. That caused all the guys that we were trying to convince at PDVSA that they should probably get on their jet airplanes and go to Miami, which is exactly what they did. And that also caused, given the economic turmoil in Venezuela, Chavez to become the president. During the next 13, 14 years, he nationalized and confiscated assets. He passed away, I think, around 2013. Maduro comes in. He did the same. Unfortunately, Venezuela has lost about a third of their population because of the economic calamity that has followed. And it's really, really unfortunate because, as I indicated earlier, when we spent time with Norway and Statoil, and we privatized Statoil, and they built a $2 trillion sovereign wealth fund, the numbers could have been a multiple of that when you consider that Venezuela has 50 times the oil reserves of Statoil. Instead of having a $2 trillion or $5 trillion or $10 or $20 trillion sovereign wealth fund, they now have $150 billion of debt that's in default. And
so it's a tragedy of very poor leadership, it appears.
It is very poor leadership. And Scott, there aren't a ton of situations around the world where the companies or the countries rather that my companies partner with confiscate their assets. And so when those countries do that, it's really the beginning of the end to them, because once you cut off foreign direct investment, then it's going to be kind of a long, slow death spiral that ends in a really, really bad place. And it did end in a really bad place. Venezuela went from about 3.4 million barrels per day of oil production at the peak in 1998 to around 500,000 barrels per day a couple of years ago, the most significant decline in oil production in any one country in the world over that time period. And because oil revenues are 75% of government revenues for Venezuela, to our knowledge, it led to a very unfortunate economic situation in that country. Now, as we're all aware, there's been some changes with the abduction of Maduro a couple of months ago in the change. And my understanding is that the new government that's in place, if you want to call it that, is cooperating. And so your question was, okay, give us a little background and also tell us what could happen next in Venezuela. Well, you probably saw the Wall Street Journal article this week about how ConocoPhillips left the country after some of their people were being kidnapped, and how they are still owed $12 billion by the Vens. And so I think between the Wall Street Journal article and the comments that Darren Woods at Exxon made recently, that it's going to be very difficult for my companies to go in until there are new terms and there's a government that's reliable that they can partner with. And that's probably going to take an extended period of time. Now, in the meantime, as we're all aware, Chevron still has their license down there. They could make some investments. There are other companies like Repsol and a few others that also could get an OFAC license and go back in and invest. And if they did that, could Venezuela's production, which has risen from 500 to around 900,000 barrels per day, rise to 1.5 million barrels per day over the next 2 years or so? It probably could. Does that move the needle on a global basis? Not so much. I mean, at the end of the day, it's not that we don't have enough oil supply today. In fact, it looks to me as if oil is going to be way oversupplied this year. But if we had another 700,000 barrels per day, it would help. Somebody would have to cut back. But you have to put this in perspective. And the perspective is that global oil supply is about 100 million barrels per day today. And so if we saw kind of a best case increase in production from Venezuela of 700,000 barrels per day, it's less than 1% of supply. Somebody would have to make room for it. It's possible, but it wouldn't be the easiest job in the world either. So that's kind of how I would shake out Venezuela.
And now I've got to ask you about Iran, because I looked on the predictive market, Kalshi, which is pretty liquid these days. And that betting market was, the odds were around 35, somewhere between 35 to 40% that the supreme leader, Khomeini, would exit the scene by July 1st. So, and there were tens of millions of dollars bet on this particular outcome on that system alone. So we have to take it seriously that it could possibly happen. Where would you put the odds? And if it did happen, what would happen to Iranian production and the price of oil, and how would we play that? During our careers, it's always been sell on the cannons. If the price spikes on geopolitical risk, you got to sell it, especially in an oversupplied market. But what are your thoughts on Iran and how that could play out?
So Iran is more important from a supply perspective. And, when you think about Iran, like Venezuela, could be producing a lot more oil if they had access to capital and technology. But you may say, well, Doug, we could have said that 30 years ago. And because the economic environment in those two countries is not conducive to additional investment, they don't have access to capital and technology, and their production is flat to down versus where it was 30 years ago. And so when you think about Iran, it's somewhat different, in that Iran is producing pretty close to where they were at their peak in the 1980s. They're right around 4 million barrels per day, a little bit less. And so they're producing a meaningful amount of oil today. Scott, it's really hard to handicap whether or not we're going to have regime change in Iran, just like it was hard to handicap whether or not we're going to have regime change in Russia. But we'll talk about how oil may be the pawn on the global chessboard in a few minutes, and how there may be other things besides supply and demand that are driving the price in just a few minutes. But if we did see some type of regime change, and I thought it was really interesting that Peter Orszag, who I know and you probably know as well, he's the chairman of Lazard, was on today suggesting that there's going to be U.S. military action in Iran over the next several days. And I go, oh my gosh, that really got my attention. Whether or not he's right or not, I don't know. But if that were the case, then I think that the military action, would probably not be oil fields or political buildings. They'd probably be, air defenses, radar, command centers, missile bases, similar like what we saw in Iraq and Libya in 2011.
Yeah, this administration does not want to upset that oil supply. I would think.
They don't want to upset the oil supply, and I don't think that they would, because I think in the aftermath, what they would like to see is Iran's oil capability preserved, just like they would like to see that in Venezuela as well. Your question was really about, okay, if we did have regime change, like let's assume the markets are correct, 35-40% is the number. I would put it a little bit higher after what Peter said, because when he talks, I listen. He's obviously got access to a lot of really interesting information. But if it were to happen, you'd have the same issue that you'd have in Venezuela, meaning in order to have billions of dollars of capital and high-end technology enter into the country, which is exactly what you'd need the super majors. You'd need Exxon, Chevron, BP, Shell, Total. And, because they have been, burned in countries like this in the past, haven't been able to make money in Iraq, which everybody thought was a war over oil. Obviously it looks a little bit, different today. It would take a little while. I mean, you'd have to have another government in, you'd have to have terms, you have to have terms that my country believes. You'd also have to have a reliable partner in the government. So I'm not sure that even if we left this conference call and found out that while we were talking that there was regime change in Iran, that it would lead to meaningfully higher production during the next 18 months. I mean, it could be, modestly higher, but again, you'd have to have an economic framework whereby companies would be willing to invest. And that doesn't exist today. And, you just can't flip a switch and have that happen overnight. At least that's been the history in a lot of these situations.
So, Doug, you've got a very interesting chart here on the screen, and I can't help but, after looking at this, just wondering if there may be something bigger going on. You mentioned oil being a pawn on the geopolitical chessboard. What is that chessboard, and how do you see the pieces moving?
Yeah, so Scott, in my career, people depended on me, whether it was big institutional investors or hedge funds or sovereign wealth funds, to help them understand where the price of oil was going, because that would be the primary driver of the stocks, whether it's the super majors, the E&P companies, the refiners, the oil field service companies, you name it. And so historically, every month for 30 years, I published what was a pretty widely read research document on the outlook for the price of oil. And we assessed it from every particular angle you can think of. And we spent lots of time with our counterparts in the Middle East, at least once a year, with the Saudis and with others as well. And, we did trips to China and Russia and you name it, just trying to understand the supply and demand and geopolitical dynamics. But in the end, the oil model that I had explained about 80% of the price, meaning the fundamental model that assesses supply, demand, inventories, explained about 80% of the price. But there's always that 20%, and that 20% can come at you out of nowhere and surprise you. And I think that while the fundamentals will always set the price in inventories, supply and demand and inventory just for demand are very explanatory if they're calculated in the correct way as it relates to price of Brent. I think this is one of those years, and 2025 was as well, whereas there are other things moving on in the background. And, we may never hear a politician admit this or not, that can change the price of oil and affect outcomes. And I think that the chart that I'm highlighting does just that. I think that both in 2025 and 2026, there's been a scenario that has meaningfully affected the price of oil and will continue to affect the price of oil until objectives are reached. So let's talk about that. So I believe that when Trump came in 2025, the first person I think that he talked to was probably Netanyahu. And I think that the second person that he probably talked to were some of the leaders in OPEC and specifically in Saudi Arabia where he has obviously a pretty positive relationship with Mohammed bin Salman, the leader of Saudi Arabia, or MBS. And I suspect that the discussion went something like this. We're going to have higher tariffs in 2025 and 2026. They could possibly be inflationary. If they are, that could slow economic growth. And so as an offset, it would be awesome if OPEC had higher production of oil, which would lead to higher oil prices and serve as that offset. And so if you're a member of OPEC or one of the leaders of OPEC, such as, Saudi Arabia or maybe the guys in the Emirates or Kuwait, you would go, well, Mr. President, we're team players too, but you have to understand that oil prices are very important to our budgets, our financial budget. So why exactly would we intentionally take the price of oil down just to offset the inflation? And I think the response was because it will defund Russia's war in Ukraine. It'll defund Iran's war with Israel in Gaza. It'll defund Iran's war with Saudi Arabia in Yemen, which is obviously very important to the Saudis. And oh, by the way, we may be able to take out Iran's nuclear capability along the way, which is pretty important to a lot of different factions in the Middle East. Saudi Arabia may get their hands on some F-38s. And we also may see the governments in Venezuela fall by the wayside, which are probably less important to the guys in OPEC, but they're pretty important to those in North America because of some of the things we've read about in the press. So out of the blue, to the surprise of a lot of people, OPEC announced they were going to increase production last April. Then they did it again in May. Then they did it again in June. And then they did it again in September. The price of oil declines meaningfully, say from $80 per barrel plus minus to around $60 per barrel today. And I think that it's safe to say that Iran, Russia, Venezuela, and Cuba are feeling it today. And if the price of oil continues to decline because we continue to be in oversupply, at least in the first half of 2026, then I think that those regimes are going to be wobbling even more than they already are. What else does that mean? Well, it means that if we do have lower oil prices and we do have lower inflation, then we probably have lower interest rates. We probably have a weaker dollar. And that puts the United States in the ability to, in a position to refinance its and restructure its debt, which many would argue should have been done several years ago, but it wasn't, so it doesn't matter. And then and only then, Scott, if the United States restructures and refinances its debt, can the United States be on a sustainable economic growth path?
Besant has been foreshadowing this. He's been talking about restructuring America's debt some way, somehow.
I think that's the grand purpose of the exercise, Scott. I mean, you said, Doug, can you kind of walk through this chart? And I went through like 8 different arrows. But there was a purpose here, and the purpose was that there are steps, and each step has to come to fruition in order for the grand purpose of the exercise to be accomplished, which I think is for the United States to restructure its debt and for the United States to be on a sustainable economic growth path going forward. And so I think that we're part of the way there. 2026 could be a year in which a decade of change happens, and a decade of change happens in a positive way for not only the global economy, but especially for the U.S. economy. Nobody told me that this chart exists, Scott, but I don't see anything in the market or from any of the commentators in the market or from the guys in OPEC or from the politicians that leads me to believe that I'm wrong on any aspect of this chart. But I could be.
If this progression plays out as you envision, to me, it would be very bullish for financial assets, both equities and fixed income.
So let's take that one step forward. So I think you're right, because if you have lower interest rates and lower inflation, S&P earnings, which are predicted to be up 15% already this year, could be up a little bit more than that. And so all those that are concerned about valuation, which does look high for S&P 500, but not so much for equal weight S&P 500, then it's not such a big deal because earnings are probably, not only do they meet expectations, but maybe they exceed expectations. And S&P 500 has another good year in 2026.
Yeah, you could also see how it could broaden out to other parts of the U.S. economy. Small cap companies could flourish in this, mid cap companies, which are valued much more attractively. So I guess my final question, Doug, is what is the path for the U.S. energy equities in 2026, the big oils, refining, the things that you focus on?
Yeah, so valuations look fine for S&P energy, but I've been out of the trade for most of the past year because this 2026, this chart shows 2026, but this was my view of 2025 as well. I just changed the date when the calendar rolled over. And so if you think about this is almost an early cycle condition, Scott, even though this isn't the early cycle because we haven't had a recession, but it'll feel like an early cycle condition, which is typically not great for mature companies like energy. Now, energy is cyclical and they will benefit, but that's after the oil price declines and then rises. And so my bet is that there's probably not a ton of downside in these names, but I think that it's not overly conducive to outperformance for energy if in fact we have a low oil price condition where the rest of the market benefits at the expense of energy. Now, simultaneously, I don't think that OPEC is going to oversupply the market for forever. I think once they have done their part and we see some of these events unfold, if in fact they do, they may not, then I think OPEC will remove supply from the market, rebalance at higher levels. And so that tells me that there will be an opportunity to put money to work in the energy sector, just maybe just a tad early, with the exception that if there's some type of military event in Iran and the market thinks that supply is going to decline or be disrupted and it can't be replaced, which I don't think is that likely, then they could trade higher over kind of the near term. But as you indicated earlier, then we go back to our playbook of selling the cannons, and there may be an opportunity to sell into strength.
Well, Doug, I want to thank you for sharing your experience and perspective with us, not just on oil, but on geopolitics. Really an excellent fireside chat. And I want to thank our audience for tuning in. So we'll see you next time.
Thank you.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice.